downside. Some dips that pretty quickly get bought. Yesterday we saw Nvidia down a tad, but generally the persistent buying is there, and if we've got one section down, something else fills the gap, and the breadth of the market has been more impressive and increasing over the past month. So this sell-off in bonds and this jump in the dollar is not too dramatic. I mean, you can see there's a lot of back and forth here. The market doesn't seem like it's really even decided which direction to go just yet, but generally you got the dollar up about more than 10 basis points. You got bonds in the 10-year down more than 10 bips. So it's not really a big move here. That being said, we did have a slide in the dollar coming into this, and we had a pretty big drop in yields as well. So the 2-year had dropped off pretty hard here the last 2 weeks. I would think that that sets this up for a little bit more bond selling today than what we're getting, but maybe the market here has sleuthed something out in the forward expectations for the economy. Maybe some of the data that we've been missing the last few weeks, which we have been, economic data, have been missing expectations. Perhaps that's keeping yields contained, but the move that we got higher in the first couple months of the year broke down pretty hard here. So for the 2-year yield, which is going to be the most important as we're watching the yield curve and whether or not it flattens or steepens based on Fed expectations, watch the 2s, particularly this gap here around 4.55 to 4.65. That's where the breakdown happened at the end of February coming into this month, and then yields have been shifting to the downside since. So if we can get back to 4.6 or so in the 2-year, kind of move to the higher end of the range we've been for the last couple of weeks, that would kind of be my baseline expectation here. We'll see if we get to close that gap. If we do, then that might create some volatility, but we're still pretty far ways away from that. So the market is right now looking like it can take all this in stride. Watching the Russell in particular today too. The small caps, which are the only futures that are down right now, have a history of being more sensitive and logically should be more sensitive to interest rates, and they've been trying to break out. The Russell's 2100 resistance level, we punched through it last week, and then we're kind of holding it right now. For the NASDAQ, looking just below about 18,300 or so. For the Russell right now, about 2090. So we're just below the highs of the last week here. This is the two-way trade, basically. A dip that got bought, a little dip that got bought. That's kind of where we're at here in markets. So some of the upside has slowed down a tiny bit, but really not much. Inflation doesn't seem like it's making further progress. Could be a problem, but so far it hasn't been throughout this year, even as the numbers have been pretty far away from the Fed's goals. Got Ben Lichtenstein here with me in the studio, host of the Futures Show. All right, Ben, so take us through the number here. I mean, because it's not exactly an ideal print.
No, it's not hot, as you said, but it is pretty warm, and maybe even hot. But the market seems to be focused on the positive, discounting the negative in line with the trend that we've seen. A little bit apprehensiveness into the number, but a positive reaction coming out of it. That's for sure. We are holding on to some gains here at 52.02. We were basically around 51.97 in the futures. Headed into this number, briefly dipped below and then rallied back here in reaction to CPI, which came in higher than expected. So turnaround Tuesday already, and we've yet to see the opening bell on Wall Street, Oliver. Consumer price index across the board coming in an increase of 0.4% in February on a seasonally adjusted basis. This was after rising 0.3% in January. According to the Bureau of Labor Statistics, the report today said that, well, over the last 12 months, all items, the index increased 3.2%. Again, the index for shelter, Oliver, a major focal point for many, rose, as did the index for gasoline. Combined, those two indexes contributed over 60% of the monthly increase. So maybe that's what the market is focused on, right? You got energies. We knew that we were going to see prices on the rise there because we've seen quite the advance. Crude oil recently back to the $80 level. Housing's been awfully sticky, stubborn, right? We've seen that. What I'm hearing is basically the favorable reaction is oftentimes we talk about how the market's kind of gearing up for something maybe even worse than what we got. And so you get the initial reaction lower and then kind of this sigh of relief. But again, I think there's going to be a reckoning to be had here still today. I mean, that first reaction may not be the right one. The second reaction may not be the right one. It'll be key to watch here. I've got treasuries which are inching back up. Look at this, the 10-year 4.13 right now. It's going to be difficult for the market to shrug off yields a move back to that 4.25 level, and we're starting to see that play out. I mean, we're kind of from 4% back through that halfway zone as we inch our way back to 4.25, and it looks like the indices are responding too.
Feels like we already had our